Hello everybody, a very warm welcome to SD Capital's official YouTube channel. Today's session is going to be a follow-up session of the last one. The last one was on mutual funds. So today we are going to look at mutual funds once again, but from different perspective. Apart from that, we are also going to address two most frequently asked questions which came our way during past 2 weeks after the mutual fund session. And lastly, we are going to finish our session with a free stock recommendation as usual. So today's session, I will start by addressing one of those questions, SIP. So many people asked us that you are discussing mutual funds, what about SIPs? Systematic investment plan, which is in fashion for last 5, 7, 8 years in India. What about them? So let me clarify for once and for all that SIP is just another way of investing into mutual funds. It is not anything fundamentally different from that. In traditional mutual funds, we invest upfront. In this case, we just invest month on month. Apart from that, all the calculations, all the return calculations we have done so far, alpha, beta, expense ratio, everything equally applies to SIP and traditional mutual funds. So whatever has been discussed in the previous session and whatever we are going to discuss today, both equally applies to SIP and traditional mutual funds. Hope that answer the question satisfactorily. Now, coming back to mutual funds. So many people asked us, why do you want us to believe that SD Capital's revenue model is better than a mutual fund revenue model? So I'm going to walk you through some numbers. Numbers don't lie, right? So today I'm going to walk you through numbers. So firstly, let's go back to our previous session, alpha. Alpha is what you are supposed to get on top of risk-adjusted expected return. So when alpha is positive, basically you are getting more for the risk you've taken. If alpha is negative, then you are getting less for the risk you have taken. In Indian mutual fund scenario, alpha is negative for 96% of the funds as per 2018 study. You can find this information in Economic Times, in Money Control, in several other sites, Value, Research Online. There are many sites. So we have assumed here for our calculation that alpha is -2. Actually, it's a very decent alpha for Indian mutual funds. We have also assumed that this particular mutual fund has got a beta of 1. Once again, most of the Indian mutual funds have beta value very close to 1. And as we discussed in the previous session, beta of market is 1 by definition. So if mutual funds beta is very close to 1, that means it is as risky as market. And most of the Indian mutual funds fall into that category. Thereby, if you look at the chart here, you can see that we have considered a fund which is as risky as market and which has an alpha of -2. We have also assumed that market has gone up by 10% first 2 years, then third year it goes down by 10%, fourth, fifth year it again goes up by 10%. As you can see, pretty obvious on the chart, and now you can see on the graph, market will return you 32 rupees for the 100 rupees you originally invested, whereas a mutual fund is going to return you roughly 20 rupees. And this is also when I haven't even considered the expense ratio. So this is the difference between market and mutual fund. Now, let's put expense ratio back into the calculation, one step ahead. Expense ratio is nothing but the annual fee. So in Indian market, once again, a typical annual fee expense ratio is 2.5%. So we have assumed 2%. So every year, 2 rupees for every 100 rupees goes towards expense ratio. And now if you can see, end of 5th year, market returns 132 and mutual fund returns 108. So it is, the end outcome is staggeringly different. Now let's come to SD Capital. SD Capital doesn't have any annual fee, 0 annual fee. We don't eat into your investable amount. Your capital stays whole with us. what we take is 30% of the profit. From the 32 rupees, we will take 9.5 rupees. How much you get? 22. So, if you look at the chart, if you look at the calculation, I'll get back the calculation here. Any year you exit, 5th year, 4th year, 3rd year, you will see even after SD Capital takes the 30% of the profit, you end up with more money in your hand compared to a standard mutual fund. So, please be aware the alpha beta expense ratio value of your mutual fund before you decide which one is better. Make an informed choice. Do the basic maths and you will make justice to your hard-earned money. That's all SD Capital wants you to do. Well, now coming back to the second question, the second most frequent question was, should I exit my mutual fund now that market is down? Now let me tell you one thing. There is a proverb, don't throw good money after bad money. Wherever you start with a mutual fund or wherever you exit, the money you get back from the mutual fund or the money you plan to invest in mutual fund, basic maths will tell you, you will be better off investing in market. You will be far better off in the long run. But that requires you to study at least as a beginner 6 to 8 months study, and then per week 8 to 10 hours. Otherwise, take help from a portfolio management company. They will do your portfolio management for you. And how portfolio management company works, they typically take into account your personal unique circumstances and your financial goal and design a portfolio which will deliver best results for your situation. They'll consider your age, your earnings, your disposable income, the number of dependents and all of that, and then design something personalized for you. That's exactly what SD Capital does. And as you saw before this earlier in this video, really, that even if we charge 30% of your profit, you end up with more. Even if SD Capital just tracks the market, we actually do better than that. But for the discussion, I assume that SD Capital does track the market, just track the market. Even then, you end up with a bigger pot of money investing with SD Capital rather than with mutual funds. The numbers don't lie, right? Now, coming back to the alpha situation, why Indian mutual funds have negative alpha? We have researched and we have found that there are two major contributing factors. One is cash trap. What is cash trap? Indian mutual fund managers park a certain amount of money in liquid cash format because they are afraid many of their customers may suddenly come back and want to may ask to withdraw money from that mutual fund. They want to exit. What happens then? So they keep certain amount as reserve, and that is roughly 3-4%. So when you are thinking you have invested 100 rupees with the mutual fund, first of all they take away 2.5 rupees every year, and then 3 to 4 rupees kept in reserve. So the money you actually invest towards market, you start somewhere around 95 rupees and year on year it goes down. Look at the chart. That will tell you the story. Now, next to that is cash trap. There is another major thing. The way Indian mutual funds choose stocks, that justifies why their alpha is negative. What are the best performers in Indian market for past 4-5 years? I'm talking about long term, not 4-5 months, not a year. 4-5 years, consistently good performing stock. TCS, HAL, Reliance. 10th June 2016 to 12th June 2020, 4 years in which Corona happened. Even then, if you look at the chart I'm sharing here, the graph I'm sharing here, TCS went up by roughly 60%, Reliance went up 3 times, and HAL appreciated 140%. These are the best performing stocks. Are they where mutual fund managers invest your money? No. If you look at the chart I'm now showing, where mutual fund investment managers have interest in are different stocks. As you can see in Reliance, TCS and HAL, foreign investors have invested significantly higher amount. On the other hand, with Indian mutual funds, ITC or SBI are very popular stocks. What has been their returns for the same period? If you look at the numbers, roughly 20% down, ITC or SBI. Then why? Why on earth Indian mutual fund managers invest in ITC or SBI instead of investing in Reliance, TCS or HAL? Does it make sense to you? There is a logic actually. These are most traded stocks on Nifty, on NSE. And why does that matter? See, when we are talking about individual portfolio, you have what, 10 HAL stock, 15 Infosys stock, 10 ITC stock, something like that. Mutual fund managers have lakhs of stocks of a particular company. So when they make a purchase or they make a sell, they need a sufficient number of sellers and buyers in the market to be present all the time. So they are only interested in the stocks where daily trading volume is really high. And if you sort by daily trading volume is nothing but number of stocks exchanging hands multiplied by the stock price. So if you sort all the Nifty 50 stocks trade volume wise, you will see ITC, SBI are some very high volume stocks. So mutual fund managers prefer these, but at what cost? They are missing out the actual good performers. As I demonstrated in the previous chart, you can go to Money Control or Economic Times and see what is the shareholding pattern for TCS, what is the shareholding pattern for SBI. You can check it out for yourself. And you will see foreign investors are really interested in those high performing stocks because they are okay to take the chance that when they are trying to buy bulk quantity or sell bulk quantity, it may take few weeks to do those transactions. But even then, that is fine with them because they make a much bigger profit. But Indian mutual fund managers are very keen on ITC SBI because they can transact lakhs of those shares in matter of a day or two. But they are missing the bigger picture. And that explains why alpha is negative for 96% of Indian mutual funds. You are taking the risk. You are not getting the return. You are consistently lagging behind by investing in typical Indian mutual funds. So, all I want to say, make an informed choice. When it seems that 30% profit sharing is really bad, it is not. We have demonstrated. And please note, SD Capital actually refund 10% in case your portfolio goes into loss. No mutual fund ever will make you an offer like that. We do because we are so confident about our process, our analysis. Okay, with that, today's session is now coming to an end. And today's free stock recommendation is Marico. Our research is showing that this particular stock has a great bull run ahead of it. So if you are, the target price and stop loss, all of that will be shared with our clients only, but we have demonstrated how Asian Paints and Bata India helped our YouTube viewers make significant profit in recent past. Our Facebook page details will be at the bottom of this video. Our mail ID will be shared. Any questions, you may contact us via our page inbox or you can send us email and we will respond ASAP. So everybody, please stay safe, stay corona free, take care. We will meet again in the next session. Thanks. Bye.